Okay, coming back. Now, what we walked through before was what was in the cash flow statement and some of the uses and why we have it. Now we're going to walk through step by step how exactly to prepare the cash flow statement. So we've been playing around here on the Ninja line and the trampoline, and now we got to get back to work and start back to talking about the cash flow statement. So with that said, let's get started. Preparing the statement of cash flows is incredibly difficult. I cannot underestimate the difficulty that people run into preparing a statement of cash flows. That goes to not only during college, when you get into practice. I have a lot of examples where I was reviewing a cash flow statement or auditing a cash flow statement, and there were errors on it that had to get fixed. So this is not something that's easy. Do not be deceived by how easy it looks to do as I walk through it in the example we're about to walk through. When I do it, it's going to look really easy. You're going to look at this and you're going to say, well, this is easy, I got it. However, as soon as you then go and try to do it yourself, you're going to run into some challenges. So please do not underestimate the difficulty of this. It appears very simple. So with that, let's get started. We're going to prepare a statement of cash flows. This is right here. This is the balance sheet beginning and ending, 2 years of balance sheet transaction data. So I have 2018 and 19 here and a differences column. That differences column is critical. The differences between last year's and this year's is basically what we use to prepare the statement of cash flows. Because mathematically, if we are able to explain all the differences in the last year's and this year's balance sheet, other than cash, we have determined what the difference in cash is because the balance sheet has to balance. So we have our comparative balance sheet. There's also some other information that we'll use. In this case, we'll have information on the loss of investments sold. So we sold some investments, we lost money on those. We recorded a loss in the income statement. In this case, it was $10,000. There's also a cash dividend that was paid for $30,000, and we had net income for the period of $160,000. So with that information, we're going to prepare a statement of cash flows. So step one, what you'll see here is a cash flow worksheet. The cash flow worksheet puts the 2 years balance sheets, so in this case, 18 and 19, across the top and their category. And then it has the difference right under there. So for instance, we have cash in 2019 was $177,000. In 2018, it was $78,000. So it represents an increase in cash of $99,000. So that is our difference, an increase in cash of $99,000. We have that for all of the other balance sheet items. Because the balance sheet always balances, that will all balance out. That's hopefully, if you've transferred it over correctly, that'll balance out. So, and then each column shows us whatever cash, accounts receivable, investments, etc. Now, what we're going to do is take each one of those changes or the difference between last year's and this year's balance sheet, and we are going to assign those differences to cash flow items. So you'll see on the far left column, we have basically our cash flow statement. Now it's empty at this point, but these are all the categories that we're going to put on the cash flow statement. We start with net income, and then we have adjustments to that to reconcile net income to cash flow from operations. And that brings us to basically cash provided from operating activities. We're reconciling, again, the cash provided by operating activities. We are reconciling net income to cash provided by operating activities. And that's what this is doing. That's why we're starting with net income and working through all the differences between net income and cash flow from operating activities. So in general, you can use kind of a canned worksheet. And if you find something unusual in one of your balance sheet accounts, you might add a line item here or there if it's material and doesn't just go into, say, other changes in other current assets and liabilities or something like that. So that's the general structure. So we, in our far left column, we have our blank cash flow statement or all our cash flow categories. And across the top in each column, we have the difference in that balance sheet line item. So we've already done cash, and that's our reconciling item. That is the amount of cash that should have, in this case, come in over the course of the period. So all the rest of our differences will give us $99,000 increase in cash. So let's work through that. Accounts receivable. So accounts receivable in the year went, let's see, it went down by $5,000. It went from $185,000 to $80,000. So accounts receivable went down by $5,000. Okay, so here's how we think about this. Accounts receivable went down. If accounts receivable goes down, what does that do to cash? Well, if your accounts receivable goes down, that means you collected that much more cash. You collected that much more cash than you recorded in net income. So if you make, for instance, let's walk through this going the whole way back. We make a sale on accounts receivable. If that money stays in accounts receivable, we have not collected any cash, right? So what this is saying is we make a sale. We make our sale, and in this case, our sales go into net income. They're the first line item in net income or in our income statement, sales. Now the question is, did those sales generate cash? Well, if those sales are sitting in accounts receivable, then accounts receivable would have gone up for the year because the sales are still sitting in accounts receivable and have not yet generated cash. On the flip side, if accounts receivable went down, which it did in this case, that means we actually collected more money on account than we made in sales. Had we made the same amount of sales as we collected, there would be no change in AR. If we had made less sales than we collected, there's an increase in accounts receivable, which is what we exactly had. And if we had made more sales than we collected, we would have an increase in accounts receivable because those sales would still be sitting in accounts receivable. So accounts receivable went down. So if accounts receivable goes down, that means we received more cash than what's reported in net income on the income statement. So we're going to add $5,000 to cash flow from operating activities, and that's going to go into the line item on the cash flow statement called decrease in accounts receivable. A decrease in accounts receivable is an increase in cash. Now, I walked through the thinking through of that process for accounts receivable. You could also, if you're more comfortable with just debits and credits, you could say, okay, well, if accounts receivable goes down, that's a credit to accounts receivable. What's the effect on cash? Well, okay, if I credit accounts receivable for $5,000, I have to debit cash for $5,000. It's an increase in cash. Therefore, it's an increase in cash. Now, we don't actually make that transaction, but if you're more comfortable working with debits and credits, and you can say, okay, well, if accounts receivable goes, in this case, down, well, then cash has to go up. And that would get you to the same point. Now, we move on from accounts receivable, which was an increase in cash. So that goes into decrease in accounts receivable, which increases cash. Now we move on to investments. Now, investments actually went down by $22,000. There's a couple things we need to keep in mind here. If you remember from what we said before, the additional information, we had a net loss reported for the year of $10,000. So we sold investments. We sold them for $10,000 less than we bought them for. That's what generates a loss. Right? We sold them for $10,000 less than we bought them for. Now, that is not a cash loss. That's important to remember. We lost money. Yes, we definitely lost money, but it doesn't represent cash, or it does not represent a cash outflow. When we sell investments, that is actually a cash inflow. I had something, I sold it, I used to have investments, and now I have cash. Well, that's a cash inflow. So what we get out of the sale of investments is a cash inflow. Well, how much was that inflow? Well, we don't exactly know yet. Then that's where we need to know the loss or the gain. In this case, it's a loss. We lost $10,000. So we know that, well, we sold them for something, and then plus $10,000 would give us the total change in investments. So total investments went down by $22,000. Well, 10 of that was a loss. So we know 10 of it was a loss. A loss is not cash, but it's sitting in net income. We need to take it out of net income to get us back to cash. So we're first going to take the $10,000 and we're going to add it back to net income to get us to cash flow from operations. And we're going to put that on the line item called loss from sale of investments of $10,000. Again, we are adding that back. Now, we have $22,000 decrease. 10 of it can be explained from the loss. Well, what's left over? 12. That means we sold the investments for $12,000. So backing up, here's what happened. We had investments on our books at the beginning of the year worth $74,000. We sold $22,000 of those investments. but we only sold them for $12,000, which is what generated the $10,000 loss. Now, we sold them for $12,000. That is a cash inflow of $12,000. It's not a cash flow from operations because we're going to presume this is not a bank where they're buying and selling investments is part of their operations. So that is not a cash flow from operations. That $12,000 that we sold the investments for is a cash flow from investing activities. So we have a cash inflow of $12,000 from investing activities. Now, had we bought investments, that would be a cash outflow for investing activities. But in this case, we sold them for $12,000. That is a cash inflow of $12,000 for investing activities. But there's still a $10,000 reduction in investments that's not explained by the cash received. Right, that's the loss. And the loss is non-cash. Even though it's sitting as a loss in the income statement, we need to take it out of the income statement or net income to get us to cash flow from operations. So we take it out, we take a loss out by adding it back. So that is why we have an add back of $10,000 for loss on sale of investments, and that's sitting on our cash flow statement. Moving on to equipment. Now, the equipment balance went up by $58,000. Well, that's pretty straightforward. Equipment goes up because you buy equipment and it goes down because you sell equipment. Well, in this case, all we did was buy equipment, if you remember from our other additional information. So we purchased equipment for $58,000. That's pretty straightforward. That is a cash flow from investing activities. We are taking cash and we are investing it in the future or long-term operations or long-term performance of this company by buying an investment in equipment. So that can represent a cash outflow as we are buying that equipment. It is a cash outflow from investing activities. Now, that's the gross amount of the equipment. We also have accumulated depreciation. So accumulated depreciation represents exactly what it says, the accumulated depreciation. Depreciation is not a cash expense. The cash went out the door when we bought the piece of equipment. The cash expense is zero. There is no depreciation cash expense. However, there is an expense for depreciation sitting on the income statement. We need, again, just like the loss, we need to take that depreciation out of net income to get to cash flow from operations. We do that by adding depreciation expense back in to net income to arrive at cash flow from operations. So you'll see that we are adding back depreciation expense of $17,000 to net income to get us to cash flow from operations. So that is how we treat accumulated depreciation. This is why it's important to have the depreciation amounts separate from the actual equipment amounts. Now, if a company has a lot of equipment or property, plant, and equipment transactions over the course of the year, you will need to get more breakout in terms of, okay, how much was the acquisitions versus disposals of the equipment. And those would get put on separate line items. So under cash flow from investing activities, you would have purchase of equipment, and then you would have sale of equipment as a separate line item, showing basically ins and outs within that category. So if we move on to liabilities, our current liabilities they went from $151,000 to $134,000. So they went down by $17,000. Those are our current liabilities. Well, if a liability goes down, well, how do you get a liability to go down? Well, you pay it. Well, you usually pay it with cash. So if a liability went down, cash had to flow out of the company, especially if it's a current liability. So for a liability to go down, cash has to go out. That is not cash. That outflow is not necessarily sitting in net income. So we need to add that back. Or in this case, let's see, we don't need to add it back. We need to take it out because it is not representing a cash inflow. It is representing a cash outflow. So we take net income minus any decreases in liabilities. Now, that's the conceptual way to think about it. If you're more comfortable, similarly to accounts receivable, if you're more comfortable with debits and credits, you could say, okay, well, how do I decrease a liability? Well, I want to debit the liability and I would credit cash, which is a decrease in cash. So if you want to reduce liabilities, you have to use cash to do that if your cash is the other side of the transaction. So that's how we think about current liabilities. Now, moving on to common stock. There were no common stock transactions for the period. Therefore, there is no impact on common stock. There's no cash flow inflow or outflow regarding common stock. And lastly, we have retained earnings. Retained earnings, as we've talked about before when we talked about the other equity statements, retained earnings changes for two reasons. It can change because of basically net income or net loss, and it can change for dividends. So in this case, we had both of these. We had net income that we already talked about. Net income reported was $160,000. Well, that's pretty straightforward. That goes on the net income line item of the statement of cash flows, and it's our beginning point for cash flow from operations. So we'll have net income of $160,000, and that's actually the amount that we are adjusting everything out of to get to cash flow from operating activities. And then we also did pay dividends. Now, paying dividends is a financing activity. It's a cost of capital. It's a cost of equity financing. So we are going to reduce cash flow. So we had an outflow of $30,000 to pay dividends out of cash. So that is a cash outflow from financing activities. So that at this point, we have now reconciled our entire comparative balance sheet. So our comparative balance sheet's on top. We've taken every difference and we've fully explained it. That can be shown down on the bottom where we have our totals. Those totals agree with what we have up top. So we have now explained all the changes in the balance sheet. That means if we did it correctly, now the biggest error that people make is they flip signs. So if it doesn't work out, go back and double check your signs. If you're off, a lot of times, if you take your difference and divide it in half, that half will be equal. If you just flipped a sign, if you take your difference or your error, say I'm off by $30,000 in what cash, the change in cash should be to what it is, well, take 30, divide it in half, which gives us 15. That means I could have flipped the sign on a $15,000 entry. That's one way to go back and try to figure that out. Now, it doesn't work if you have multiple errors, because then it's going to end up with whatever additive divided by 2, which is harder to reverse engineer. So that's one thing to keep in mind. Double check your signs if you have an error. Usually signs are your biggest problem. They're the most frequent mistake you end up with on a cash flow statement, especially if you're looking at and it doesn't reconcile. It's probably going to be because you flipped a sign somewhere. Okay, so at the end, all we do is just carry everything across. So we'll start with net income of $160,000, and then we have adjustments to reconcile net income to cash provided by operating activities. We start with our depreciation expense. Again, we are adding that back because that is a non-cash expense that's sitting on the income statement. So if we want to go from net income to cash, we have to add back depreciation because that's not cash. And then, so we're adding back $17,000. We're also adding back our loss on sale of investment. Again, that was a non-cash transaction. Actually, when we sold the investment, we received cash. We didn't give it up. So, but that $10,000, that loss is sitting in net income. So we need to add it back to net income of $10,000. We also had a decrease in accounts receivable. Well, a decrease in accounts receivable is an increase in cash. That means we collected more cash than the sales we reported on the income statement, so we add that back. That gives us a total of, we need a decrease in current liabilities. Well, there was a decrease in current liabilities. You do that by spending cash. That was $17,000. So we're going to take our $17,000 and take that out of net income, which gives us, at the end of the day, net cash provided by operating activities of $175,000. That's pretty straightforward. And then we move on to investing activities. We do the same thing. We have net cash provided by, in this case, it was used by investing activities of $46,000. And then we will have, then that completes investing activities. Then we move on to financing activities. We have, in this case, cash used from financing activities, which we paid a dividend. And that was, $30,000. And that gives us, that reconciles our cash. So it gives us that if you sum up the cash flow from operating activities, investing activities, and financing activities, it gives us a cash change of $99,000, which is exactly what we have as shown as a change on the balance sheet, the comparative balance sheet. So we are done and we have completed our cash flow statement. We just collapse everything in the middle and we end up with a beautiful cash flow statement that shows basically our cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities at the end. Now, there is some additional information that we need to put on a statement of cash flows or disclose in conjunction with our statement of cash flows. And these are significant financing and investing activities that don't affect cash. So the idea is there are transactions that could essentially, they normally settled in cash, but they somehow bypassed cash. But we want to disclose those anyway. For instance, if we issue common stock to purchase assets, Well, normally you would issue common stock, get cash, use the cash to buy assets. In this case, we're kind of skipping the cash part and going straight from common stock to buying assets. Well, we're going to disclose that. Similarly, if we do conversion from bonds to common stock or stock to bonds, we're going to disclose that. And if we issue debt to purchase assets, just like equity, that would get disclosed. And then if we have some exchanges of long-lived assets, so basically think of like an exchange transaction, instead of selling assets and buying other assets, we're just going to say a trade-in or something like that. That's going to come through as a significant non-cash activity. And those, again, they need to be disclosed separately in conjunction with the statement of cash flows. That pretty much wraps up our discussion of the cash flow statement and our discussion of both balance sheet and cash flow statement together, which was the latest chapter that we've been working through. So at this point, you should understand basic uses and limitations of these statements. Understand different categories. So if we go back to the balance sheet, understand assets, liabilities, equity. What are they? What goes in? What's excluded from those definitions? Within the cash flow statement, understand what goes into cash flow from operating activities, financing activities, investing activities. What goes in there, i.e. what's excluded from there. How these statements get presented, and then some of the ways they're used by investors primarily. So with that, we're going to wrap up. Thanks for watching and have a great day. God bless.